Welcome to another episode of Accounting Academy. It's me, Surendran Betrapara, speaking to you. Today's topic is Modigliani and Miller Theory Part 2. Yes, we have seen Modigliani and Miller Theory Part 1 when corporate taxes does not exist. Modigliani and Miller, Franco Modigliani and Merton Miller, they published their first paper during the year 1958 and they suggested that when corporate taxes does not exist, that theory proves very accurate. Okay. When corporate taxes does not exist, overall cost of capital and value of the firm remains constant at all degrees of financial leverages. At all degrees of financial leverages, value of the firm and also the overall cost of capital remains constant. Therefore, there is no optimum capital structure to influence the value and also overall cost, according to Franco Modigliani and Merton Miller. And it was their opinion during that period, 1958, when they published their first paper. And they published their second paper, the follow-up paper, in the year 1963. A follow-up paper published by these two. And they are of the opinion that corporate taxes are existing, or they withdrawn that assumption given in the paper first, that there are no corporate taxes. Because interest, it is a tax deductible expense. Interest is a tax deductible expense. But a dividend, it is not a tax deductible. This encourages the companies to include more portion of debt capital in the capital structure. So when cheaper sources of finances are included more in capital structure, thereby they can maximize the value of the firm. With the existence of corporate taxes, companies can maximize their value and they can reduce the overall cost of capital, according to Now. So according to them, there is one optimum capital structure which maximizes the value of the firm and also reduces the overall cost of capital. An optimum capital structure can be designed by the firm, designed by the financial manager at that point where the value is maximum and overall cost is very minimum. And according to value of unlevered firm can be calculated with the help of one formula. Value of unlevered firm, it is abbreviated as VU. Value of unlevered firm is equal to EBIT into 1 minus T divided by KO. Value of unlevered firm is equal to EBIT into 1 minus T divided by KO. Value of unlevered firm means value of a firm having no debt capital. Debt capital ഇല്ലാത്ത ഒരു ഫേമിനെയാണ് അൺലിവേർഡ് ഫേം എന്ന് പറയുക. ആ കമ്പനിയുടെ വാല്യൂ എങ്ങനെയാണ് കാൽക്കുലേറ്റ് ചെയ്യുക? EBIT into 1 minus T divided by KO. EBIT means earnings before interest and tax into 1 minus T. T stands for tax rate. And KO stands for overall cost of capital. VU means value of unlevered firm. Okay. And value of levered firm can be calculated. Value of levered firm can be calculated with the help of a formula, that is levered firm is equal to VU plus DT. Value of unlevered firm plus DT. Here VL means value of levered firm, VU means value of unlevered firm plus D stands for D is equal to amount of debt. Levered firm means a firm having debt capital in their capital structure. Okay. D stands for amount of debt. T stands for tax rate. Okay. By using these two formulas, we can calculate the value of firms. Value of unlevered firm is equal to EBIT into 1 minus T divided by KO, where T is equal to tax. Value of a levered firm BL is equal to value of unlevered firm plus DT. D stands for amount of debt and T stands for tax rate. So by using these two, we can calculate the value of firms. Okay, so according to MM, there is one optimum capital structure to influence the value and also overall cost of capital. So a financial manager can design a particular capital structure. At that point, value of the firm is highest and overall cost of capital is lowest. That structure is known as optimum capital structure, and this can be proven by an example, one problem. Yes. Yes, problem. There are two firms, A and B, which are exactly identical except that A does not use any debt in its financing, while B has rupees 4 lakh 10% debentures in its financing. Both of the firms have earnings before interest and tax of rupees 3 lakh 20,000, and after tax capitalization rate is 16%. Assuming the corporate tax of 50%, calculate the value of the firm according to hypothesis. പ്രോബ്ലത്തിനകത്ത് പറയുന്നു എയും ബിയും ആണ് രണ്ട് കമ്പനികൾ. സോ ദേ ആർ ഐഡൻറ്റിക്കൽ ഇൻ ഓൾ റെസ്പെക്ട് എക്സെപ്റ്റ് ദെയർ ക്യാപിറ്റൽ സ്ട്രക്ചർ. ക്യാപിറ്റൽ സ്ട്രക്ചറിൽ മാത്രമാണ് വ്യത്യാസമുള്ളത്, ബാക്കി എല്ലാം കൊണ്ടും അവ തുല്യമാണ്. എ ഡസ് നോട്ട് യൂസ് എനി ഡെപ്റ്റ്. എയുടേത്, എ എന്ന് പറയുന്ന കമ്പനി അൺലിവേർഡ് ഫേം ആണ്, കാരണം അവർക്ക് ഡെപ്റ്റ് ക്യാപിറ്റൽ ഇല്ല. വൈൽ ബി ഹാസ് rupees 4 lakh 10% ഡിബഞ്ചേഴ്സ് ഓഫ് ഇൻ ഇറ്റ്സ് ഫിനാൻസിങ്. ബി എന്ന് പറയുന്ന കമ്പനി ലിവേർഡ് ഫേം ആണ്. Both of the firms have earnings before interest and tax of rupees 3,20,000. രണ്ട് കമ്പനികൾക്കും 3,20,000 തന്നെയാണ് earnings before interest and tax, EBIT. After tax capitalization rate is 16%. KO is 16%. Assuming corporate tax of 50%, tax is equal to 50%, and calculate value of the firm. Okay. Yes, welcome back. Value of unlevered firm. Value of unlevered firm A. ഇവിടെ ഈ പ്രോബ്ലത്തിനകത്ത് പറഞ്ഞിരിക്കുന്നത് എ ആണ് ഡെപ്റ്റ് ഫൈനാൻസ് യൂസ് ചെയ്യാത്ത ഫേം. Therefore A, it is unlevered firm. Okay. VU is equal to EBIT into 1 minus T divided by KO. EBIT given in the question, it is 3,20,000. T is equal to tax rate is equal to 50%. KO is equal to 16%. All items are given in the question. Therefore, it is easy to calculate value of unlevered firm A. EBIT 3,20,000 into 1 minus T, tax rate 50%, that is written as 0.5 divided by KO 16%, that is equal to 3,20,000 into 0.5, that is equal to 1,60,000. 1,60,000 divided by 16 into 100. 1,60,000 divided by 16 into 100, that is equal to 10 lakh. 10 lakh. So this is value of unlevered firm. Value of unlevered firm A is equal to 3,20,000 into 1 minus 0.5 divided by 16%, that is equal to 10 lakh rupees. And let us calculate the value of levered firm. Value of levered firm is equal to value of unlevered firm plus DT, D into T. Value of unlevered firm is equal to 10 lakh. 10 lakh plus D is equal to 4 lakh. Company B, firm B is using debt capital of rupees 4 lakh, and the rate of that debt capital is 10%. Okay. 10 lakh plus D, 4 lakh. 4 lakh into 4 lakh into T, tax rate is equal to 50%. 4 lakh into 50% or 0.5. That is equal to 10 lakh. 10 lakh plus 4 lakh into 50% is equal to 2 lakh. So 2 is equal to 12 lakh. Total value of levered firm B is equal to 12 lakh. value of unlevered firm A is equal to 10 lakh. Okay, so when corporate taxes are assumed to exist, value of the firm is here in the case of A, unlevered firm. Unlevered firm means a firm not having debt capital. They are identical. These two firms are identical in all respect except their capital structure. B firm is using debt capital in their capital structure and its value is highest. Compared to A, its value is 2 lakh more. Okay. Here it is only 10 lakh and 12 lakh. Therefore, by the use of debt capital in the capital structure, a company can maximize its value and they can reduce the overall cost of capital. Okay. Anyway, value can be maximized with the help of this tax, the existence of a tax or otherwise the existence of a debt capital in the capital structure according to MM. And there is one capital structure which is known as optimum capital structure. Okay, thank you.